This is Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of the book Why America Matters. I wanted to talk today about a recent article I just put out called The Banking Crisis Great Reset. And this, as the name implies, has something to do with the banking crisis that we've seen going on in the last couple of weeks. It's right now the first moving into the second week of April. And I make the argument that the banking crisis is not over. And what might we look for? And who benefits from what we see going on around us? So a little bit of history here. On Sunday, March 5th, 1933, just one day after his inauguration, the newly ensconced president, Franklin Delano Roosevelt, declared a banking holiday. He closed all the banks in the entire country for 4 days. This was in the depth of the Depression. Banks had been closing at a record pace, hundreds per year. In fact, over 4 years, between 1930 and 1933, over 9,000 banks were closed in the middle of the Great Depression. President Roosevelt closes all the banks. By the time they reopened the following week, financial regulators had scoured the banking system to determine which banks would survive and which would not. Sort of like the emperor sort of saying thumbs up or thumbs down, so it went. So in the history here, there were about 5,400 banks that were not licensed by the Treasury to reopen. So literally, out of all the thousands of banks that were then active before that weekend, 5,400 were not relicensed, at least initially, and over 2,100 were never licensed again. They were either suspended, merged, or liquidated. So basically, this was a purge of the banking system of weak banks, small banks mostly. Most of the large banks were allowed to reopen, but a lot of the small banks were forced to close or merge or otherwise. By the time this financial crisis was over, total bank deposits had fallen by 42%. The U.S. money stock, the money supply had fallen by a third, exacerbating the credit crunch and extending the Great Depression for years. Now, in the following days, weeks, and months, President Roosevelt would often, by extra legal use of emergency powers, ratified only after the fact by a shell-shocked and thus compliant U.S. Congress, radically changed the financial and regulatory landscape of the United States. Most big banks were allowed to reopen, but thousands, as we heard, of small banks were not. Interestingly, there was a move against gold because the dollar was under pressure. The U.S. is running out of gold reserves, so President Roosevelt said that private U.S. citizens could no longer hold gold. It was contraband. You were a criminal if you kept it, if you didn't turn it in to your bank or otherwise. And the export of gold was also outlawed using a 1917 law from two decades before, the Trading with the Enemies Act, repurposed in order to stop the flow of bullion for U.S. coffers. So with the stroke of a pen and a bit of a middle finger to the rule of law, they also broke the clauses in private debt contracts that required payment of gold on demand if demanded by the creditor. So these clauses were completely voided anywhere in the United States by an act of Congress. So the link between the dollar and gold was permanently broken, and money became only what the government said it was. Now, in the main, the initial actions that FDR undertook ended the banking crisis. There were things that already had happened under President Hoover that were working towards the end in terms of resolution trust. Not that was the name of it, but a trust was established to rebuild and reposition the banks. The point that I want to make isn't whether those initiatives were necessarily good or bad in themselves. The point I want to make is that governments and regulators never let a good crisis go to waste. These powers proactively use banking crises, in some cases stimulating them, in order to impose sweeping changes that would never be allowed in normal times when fear and panic aren't the prevailing sentiments. So that same year in 1933, the Federal Deposit Insurance Corporation was established, arguably increasing systemic moral hazard, i.e. the fact that people would take risks beyond the scope of what they normally would because they knew that their deposits would be insured. The Securities and Exchange Commission was formed, along with a myriad of other 3 or 4 letter agencies as part of the federal government that would dramatically and permanently consolidate power in the hands of the government and envelop American businesses in a web of bureaucratic red tape, which today increasingly tightens and binds and restricts businesses from functioning normally in order to comply with various regulatory obligations. Now, subsequent crises would tend in the same direction. So in the 80s, we had the savings and loan crisis, which led to the closure of about a third of all S&Ls, about over 1,000 of them. That cost about $132 billion to taxpayers at the time. That's roughly $300 billion today. And it resulted in the insolvency of the S&L's Federal Savings and Loan Insurance Corporation, the equivalent of the FDIC for the S&L industry. And it brought a new wave of consolidation and regulatory reform. And of course, so did the global financial crisis, which began in 2008, which resulted in this monstrosity of banking legislation called Dodd-Frank and the increase of government control over the too big to fail banks. And again, as we saw in each other crisis, consolidation in the banking sector. So this is the main theme that we want to get at. Question: could it be possible that the Biden administration and the federal regulatory bodies see a silver lining in a new, still unfolding banking crisis? What ends might such a crisis permit? So one of the opportunities from a government regulatory perspective is to accelerate the process of banking sector consolidation. Among other benefits, this would reduce the supervisory complexity into fewer but much larger banks, which would be under the control of the Federal Reserve rather than state regulators or less competent regulatory agencies that have not been as efficient or as effective in regulating the banking industry. Now, pro-consolidation arguments tend to focus on financial system stability. So a recent opinion piece in Bloomberg Opinion said, consumers get a lot of choice, but the competition, such a fragmented system can lead to instability. Well, this is a strange line of reasoning. If you think about it, the thousands of banks, if fair enough, they may not make for a very efficient system, but like widely distributed and independent nodes on a network. Think the internet, think blockchain behind technology behind crypto, think even interbank payment systems around the country and around the globe. There's resiliency and security in decentralization. The breaking of one strand or one node doesn't take the whole system down with it. I think it's important to point out that greatly reducing the number of banks won't prevent deposit flight. Deposits are moving today from regional and smaller banks to the too big to fail banks, yes, but most of the movement of deposits to date has been in money market funds or directly into treasuries, yielding 4 to 5%, well above what's on offer from the banks, anywhere from 0.01 to 1.5% for a year-and-a-half CD. This gap is widening. Depositors are becoming aware of it. Hold on, why is my money sitting here? It could be money market funds. It could be directly invested in treasury bills, bonds, or otherwise. And banks are losing a lot of their liquidity as a result. Now, banks have an inherent weakness, which is this idea of a liquidity or maturity mismatch, which is their liabilities are liquid, like deposits that can be pulled out quickly in times of trouble, but their assets are illiquid, loans or investment securities that, especially when interest rates rise rapidly as they are today, they can only be sold in a hurry at a steep discount to carrying value. So in normal times, this really poses no problem, but when depositors and investors get twitchy, get nervous, it can spell the end of that bank and instability for the entire system. The point is that this is as true for the too big to fail banks as it is for the regionals or smaller. We saw that, of course, in the global financial crisis. That's where the liquidity crisis was really centered. But when it happens there among the systemic banks, it has even greater consequence. So concentration actually that further consolidates the banks, consolidates the risk into the too big to fail systemic banks that were the epicenter of the crisis. That, along with this increasing regulatory oversight that comes out of Dodd-Frank and other initiatives, actually leads to not a better system, a more efficient system, but fatter, lazier, and slower banks without reducing the risk of bank runs and liquidity crises. Silicon Valley Bank was the 16th largest bank. First Republic, now trying to be rescued by other banks, 14th largest. These are both covered by the Federal Reserve. Regulators were not doing their job, were not on the watch. So consolidation isn't the solution here. Think about it. Even today, the plethora of regional and smaller banks, thousands of banks across the country, at least they do provide diversification. And importantly, most importantly, these are the banks that extend credit to small and medium-sized businesses in local communities that the big banks won't touch. The big banks today are no longer in the banking business of lending money as much as they are in the trading business and investing in securities. And when they do lend, big banks lend to big businesses. So it leaves out most of the main street economy. And by the way, this diversity of banks also affords some protection from the deplatforming, the debanking, and even the outright asset seizures that we've already seen with the too big to fail banks, and we've talked about in previous episodes. So most importantly, the thing to take away is the diversity of banks distribute risk across this widely decentralized network and provides optionality. I want to shift gears a second and just go a little bit into a hypothetical, an illustration. This isn't necessarily going to happen, but imagine with me, if you would, that the bank runs resume and become systemic, threatening the stability of the United States financial system. Well, what do the regulators do in that case? What will they do? What is their next move? What is their next play? One thought, again, just for illustration, just to think about a thought piece. What if they stepped in, just like FDR did over a long weekend or a banking holiday, again, closed hundreds or even thousands of weakened regional and community banks, forced, well, they then own it. The FDIC owns the assets at that point. They pushed those assets and deposits into a few dozen increasingly too big to fail banks, probably sold on the cheap at a discount to their face value. The regulatory triple alliance of the Fed, the FDIC, and the US Treasury fund and guarantee the liabilities of this new consolidated too big to fail system. And the Federal Reserve itself plugs the deposit gap for the remaining too big to fail banks by providing essentially, or practically at least, unlimited liquidity, which in a way results in a backdoor nationalization of the US banking system, not through a TARP like equity ownership as seen in 2008, the troubled asset purchase plan that was put in place at the time, the Bruce program, where the government invested directly in names like Citi and other banks that were struggling at the time, AIG Insurance, all of these where the government basically invested. Government made money on that at the end. It worked out fine in that case. But here, the nationalization would be through loans created by the Fed and backstopped by the US Treasury. It would also create an opportunity, this new crisis or next leg of the crisis, for the regulators to further banish crypto from the banking system, eliminating the on-ramps and off-ramps that allow tokens like Bitcoin and Ethereum to be exchanged to and from fiat. And another idea, what if gold once again became contraband? The things that we could count on in a scenario like that would be that inflation would soar, credit would be tightened. As a result of credit being tightened, unemployment would surge and the economy would go into recession or greater, even worse. Now you can think of an alternative variation on this scenario, which is the Federal Reserve directly issues newly created CBDC, central bank digital currency credits, to uninsured depositors of the closed regional and community banks that had failed, consolidating these liabilities directly on the central bank's balance sheet, and in that sense, for the first time ever, competing directly with the commercial and retail banks. The dangers of CBDCs, which we've talked about before here at Stonewall, include total government surveillance and control. These things would become a reality very quickly. Social credit scores could follow, along with the behavior modification that comes from knowing that certain purchases or political views result in negative scores, or even limitations on use of your CBDs, or in certain cases, outright confiscation of CBD assets, which, as we've talked about in other articles and videos, is legal in some states under certain forfeiture clauses, even without being convicted of a crime. So all this, as I mentioned, is a hypothetical. The details of my illustration are probably wrong in their details, but I think the direction of travel is a possibility, if not a probability, if there were another significant leg down in the deposit run. The banking crisis, which in my view, sitting here from the first week of April, is far from over, April 2023, and it may create an opportunity for the federal government to impose a great reset in the financial sector, in the banking sector in particular. And as a result, the freedoms that Americans have come to live with and expect up to this point in their banking and financial lives may suddenly be changed in a moment. Let's hope that doesn't come to pass, but I think it's something that's worthwhile for us to consider. I hope if you've enjoyed this, that you'll like this here on YouTube, that you'll share it, that you'll subscribe to my YouTube channel, and we will see you next time here on Stonewall.com.